Thanks for staying with us, everyone. Inflation for the month of March 2024 has seen a sharp increase to 25.8% from 23.2% recorded in February this year. Inflation for both locally produced items and imported items went up substantially to 26.8% and 23.8% respectively. According to the Ghana Statistical Service, food, non-alcoholic beverages and transport were the main price drivers for the rate of inflation. It added that food inflation went up by 29.6%, whilst non-food inflation recorded 22.6%. Here's government statistician Professor Samuel Kobene announcing the figures a while ago.
24 rate of inflation stood at 25.8% year-on-year inflation relative to 23.2% recorded for the month of February 2024. This indicates that we have seen a surge in the rate of inflation by 2.6 percentage points, increasing from 23.2% to 25.8% for the month of March 2024. Disaggregating this from a food and a non-food perspective, rate of inflation for food was 29.6% relative to non-food 22.6%. Both food and non-food inflation have seen a 2.6 percentage increase in its rate of inflation between February and March 2024. From a locally produced item and an imported item perspective, we continue to see locally produced items recording a higher rate of inflation relative to imported items, as locally produced items recorded a rate of inflation of 26.6% relative to 23.8%. Both locally produced items and imported items have seen an increase in their rate of inflation between February and March 2024, but we've seen a much sharper increase in inflation for imported items, as inflation for imported items rose from 21.1% to 23.8%, indicating a 2.7 percentage point difference, as we saw a 2.0 percentage point difference for inflation on locally produced items.
Well, joining me on Zoom is economist and research lead at GCB Capital, Courage Botie, to make sense of this latest numbers from the Statistical Service. Good afternoon to you, Courage. So, a huge jump from over 2% we have seen in February. Any surprises there? You're muted.
Sorry. Good afternoon to you and your listeners. Huge jump, yes, but I don't think it's a surprise at this point. It's something I think I've talked about in my previous discussion of inflation. Indeed, it even fell slightly below what I was expecting, about 26%. What is happening is largely due to base movement. If you recall, March 2023, we saw sharp decline in inflation from, I think, the 50s, they were about to 45. It was a decline of 7.8%. In a single print, and we saw across the food, non-food, and the headline month-on-month inflation that there were deflation recorded. Now, by the way inflation is calculated, changes in the CPI from a certain base period to the current period, that lower base from March 2023 will mean that inflation will increase for the period. Add that to the fact that we've seen some cedi depreciation within the data window, and we've seen also fuel prices surge at the pumps within the period, which is reflected in transport inflation for a period. It is not a surprise at all that it's crept to the level we are seeing it now.
Courage, we are currently experiencing a power crisis. Fuel prices are going up. We expect transfer fares to go up in the coming days. Also, we are also having to deal still with currency depreciation. Looks like inflation is going to continue to rise in the coming months. Is that your analysis?
Well, so those are risks to the outlook, which we must acknowledge will be the case. If you realize all the factors you mentioned do not only have their direct effect, they also have their second round effect. For instance, transport fares. We've already seen not increases in transport fares per se, but we've seen transport inflation go up, and it's reflected in the fuel people are purchasing and all that. GPRTU, I believe, will respond soon with some increments that they are touting. Those would have both direct and indirect impact. It would affect the general pricing of goods and services on the market. cedi depreciation, yes, I think there is returning some sense of stability within the last week or so, and in this week we are in now. partly due to the inflow from the World Bank and maybe the other factors that may support the outlook going forward. And of course, the monetary policy authority stance on inflation and cash reserve ratio may also play a role in supporting the inflation out, in fact, currency outlook maybe going forward. So there are risks which will pose threats to the outlook going forward, but there is also the pull factor or the support factor. Generally, the base drift will continue, this time in a favorable way. And so the expectation is that these pressures we're seeing now will moderate any anticipated decline in inflation. So there could be decline from April going forward. From the simulation I'm doing, we could begin to see some declines from April, but not as much as would have been, but for the price pressures we are seeing now.
All right, that's some maybe good news to consume at this point. But the World Bank early this week raised concerns about rising inflation, how that could potentially impact on our economic recovery. How seriously should we take this warning?
Well, and I think that is what the Bank of Ghana has been trying to do with everything they've done so far. It's not popular. The policy rate still at 29. People that wish it's much lower than that. The cash reserve ratio adjusted to the levels they are now, that will be absorbing about 18 billion from the banking system if the banks do not react with low credit creation. Those are shocks to the banks and all that, but they are the necessary better pill we need to take now to ensure inflation is firmly anchored. We have the threats from the global side, right? Crude oil prices surging, the Suez Canal attacks, the bombing of refineries in Russia and all of that, affecting both supply side and the shipment, which are reflected in the higher prices we're seeing. In fact, the most projections are showing prices around $100 per barrel for the remainder of the year. These are all shocks to inflation that needs to be monitored. And that is why both on the fiscal side and on the monetary side, there must be that coordination to try to get inflation sustainably low. The Bank of Ghana is taking the necessary step. We are now hoping for the government of Ghana in an election year and giving all that is at stake to also remain disciplined and steadfast in the fiscal consolidation drive. When we bring those two elements together, two sides of the equation together, and support it with growth in the real sector, which the Bank of Ghana is trying to achieve with encouraging credit growth, then we could contain inflation pressures. But otherwise, there are risks to the outlook that may threaten even a reversal from the trend we are seeing currently.
Let's dig in a bit on the Bank of Ghana's moves, because you mentioned it. I mean, the increase of the cash reserve ratio for the banks to help tame inflation and also currency depreciation. I know there's been a lot of concerns raised by the private sector about how that impacts on lending. But how soon do we see this reflect on its impact on inflation?
Well, its impact, so the policy took effect from 1st April, beginning of this month, and the data window for April inflation ends in the first week of April, really. So in terms of impact, not much in April, but probably from May. The withdrawal of 18 billion is significant, right? And it will play a role in the level of liquidity on the market. It also has the added potential of stimulating FX sales from those who are holding it, because what this has effectively done is tighten GHS liquidity conditions in the banking system. And so for those who want CD liquidity and may not immediately have, because they are stuck with the Bank of Ghana, they would want to sell their FX to generate liquidity. That would help also improve the FX liquidity conditions on the market, really. So its impact on inflation, I believe, will be maybe fully felt directly from April, but then the impact of these things are staggered, they are lagged, and they are realized over time. So it won't be instantaneous, but from May, inflation will begin to see it trickle in all the way into the latter part of the second quarter.
Yeah, and so we have seen the monetary steps being taken by the Bank of Ghana. On the fiscal side, what should the government be doing right now?
Well, more of the same things we're doing now. If you are aware, the IMF team is in town. From my reading of the data, the quantitative numbers, reference numbers for end year 2023 it appears most of them are broadly on target from what we've learned from the Bank of Ghana's latest data release, really. Most of the data on target. The structural reforms and the indicative targets are what we do not have adequate information as to where we are with that. And we don't know whether completing the external debt restructuring will be tied to a successful completion of the second review. So all of these are up in there, but more of these keep the fiscals in check. And I dare say that there is the temptation to overspend in an election year, but the stakes are much higher. The extent of damage we are trying to correct, and then the consequences of not complying. Not only do we have this review going on, there is another review later in the year, which is expected to be completed by November, just ahead of the elections.
Right.
How those come out and whether we successfully complete those or not has a lot of implications for where the elections will go. And so it's even in the interest of the current government, if they are minded to win the election, to try to show good numbers at half year and later in the year. And so more of the same as we've done in 2023, more of the same, ensure the stability, ensure the consolidation is on course. And when we do that, we can also contain the inflation risk.
I don't think I've had the opportunity to ask you how you think the review would go. Already there are issues coming up about our revenue gap and all of that. What do you think would be the outcome of this second assessment of our program?
It is revenue an important issue. I think it's our biggest problem that we did not go ahead with the VAT on electricity alone creates gap from the beginning. I think from my reading of and hearing the governor on the last MPC, it appears we front-loaded expenditure in the first quarter of the year, which will require some adjustment to bring it back to within range. All of these are conversations. So we would have to now convince the IMF and of course, under the program that we are able to do the needed adjustment, either to increase revenue or tame expenditure to keep the target within check. And so at least in terms of the reference period, end of 2023, I think the numbers are largely within the range. It is the period thereafter that needs to be looked at. And what I'm not very sure about is whether this review is tied to the completion of external debt restructuring, which timeline we've missed, because we were told end of quarter one. We are in April now, and not much has been said, at least on the commercial side of things, really. So that clarity, I believe we will know on Friday from the press release. But my expectation generally is that it will take a while to get the board's approval again, given the lingering issues that needed to be ironed out. On the staff level, we will reach an agreement, but for the board to approve, I think a number of issues may be outstanding and needs addressing, just as we've seen in the first review. And the May timeline we're looking for to get the money may be too soon. We may have to go a bit longer, if my reading of the data and the conversations is right.
Thank you so much, Courage Botie. Insightful as always. I appreciate your time with us this afternoon on The Marketplace. Thank you.